Global fixed income markets are quite interesting at this moment in time. I think people are still trying to figure out the extent of trade wars and the impact it will have on the outlook for global growth. But it's a sure indication that as this continues, it doesn't help with global sentiment. If you look across to China, we're seeing some of the lowest GDP forecasts that we've seen for a long time, and that obviously has implications for the views on emerging markets as a whole. If you look at the US and the Eurozone, we've seen for 2019 some data that has come in below expectations. And so there's sort of been a shift in the market, and especially in global fixed income markets, to expecting central banks to now move to more accommodative interest rate policy. So in the US, that implies the market's now expecting interest rate cuts, and in the Eurozone, Mario Draghi has now been talking about extending quantitative easing. From a market perspective, the biggest move that we've seen is in the US 10-year yield. So these yields were trading in 2018 somewhere around 3.2%, very much expecting higher growth and inflation in the US. These bond yields have now retraced to below 2% and average about 2% as we speak. Eurobonds have also gone further into negative territory. We think there's a lot of fear built into our local fixed income markets. For some time we've seen very high yields on our curves, and that's been across all of our curves, despite the fact that inflation and inflation expectations have actually moderated quite significantly over the last few years. Off the back of this, the bond market has performed quite well over the last 3 years. As we have mentioned before, the fundamental driver of our bond yields should be our inflation rate and expectations of inflation. And currently, inflation sits close to 4.5%, and we attribute this to the competence of our Reserve Bank, who have managed to anchor inflation expectations closer to 4.5%, as opposed to the historical 6% upper band. To add to this, the recent core inflation number was 4.1%, which gives you sort of an indication of the low inflationary pressures we are seeing in the South African economy. Growth is also further disappointed in 2019. And that's really on the back of lower business confidence and consumer confidence, and then concerns around our state-owned enterprises. This combination of low growth and low inflation has historically been a good environment for fixed income assets, and we think going forward these bonds should deliver quite good returns for our clients. Inflation is expected to continue to be low going forward. And as such, we have entered into an environment where now the SARB is expected to cut interest rates going forward. This has resulted in the yields in shorter dated instruments moving down significantly, but this hasn't been reflected yet, in our opinion, in the longer dated bond yields. We feel the real yields available on the longer end of the curve remain very attractive, and as such, we've increased our holdings. We continue to be buyers of inflation-linked bonds where the real yield is trading around 3%. We believe the asymmetry is quite attractive at that point. These assets also give us protection for our portfolios should we see any unforeseen inflation spikes in SA. In our view, the local bond market offers some of the best risk-adjusted returns available currently. In recent years, we've been buyers of corporate credit and bank senior paper, where the spreads have met our idea of fair spread, and these have been attractive investments for our clients. Of late, we've seen these spreads come in quite significantly, and as such, we are more sellers than buyers. With the move down in shorter dated nominal bonds, the NCD curve has also moved down quite significantly, and as such, we will look to sell where we see value. We are also not buyers of global bonds, where we think spreads and yields are quite expensive.